It seems like all you hear about nowadays is how wealthy people like politicians and celebrities and these big business CEOs, they make lots of money, but they pay very little in taxes. But how do they actually do it? Believe it or not, they're usually not doing anything illegal. And one important thing to understand before we get into these tax strategies is that the reason that wealthy people are oftentimes able to do these tax strategies is because potentially the government's incentivizing them to do so. So for example, on a basic level, if you have a child and you're married, you may be taking advantage of these incentives already by getting a child tax credit and also being in more forgiving tax brackets. This is likely because the government believes that the family structure is overall beneficial for the country and may need or deserve certain tax incentives, so they're willing to incentivize that. On a more advanced level, the government also incentivizes certain investments at different points in time, like oil and drilling partnerships, because they feel that these investments being made into these ventures overall benefit the economy. So again, they're willing to provide a tax break for that type of investment. Now, before getting into these strategies, I really do want to emphasize that the strategies that we're going to be going over in this video are not financial advice. This is just purely an educational discussion, and I do highly recommend that you do your own research before considering any of these strategies. But now let's get into some real tax strategies that may sound illegal, but in fact are completely legal if done correctly, and you don't have to be famous or ultra rich to take advantage of these. We're going to start from a little bit more basic and get a little bit more advanced as the video goes on. So first, we can start off with something that may help people whether or not they have a large net worth or a high income. And this is a strategy that involves charitable contributions and property taxes. The first thing to understand about this strategy is the difference between the standard deduction and itemized deductions. So the standard deduction is the base deduction that everyone gets on their tax return. Itemized deductions are a separate category of deductions like charitable contributions, property taxes, as well as other things like mortgage interest and medical bills, and you only get to take one or the other. So you only get to take either the standard deduction or the itemized deductions, and you typically take whichever's higher so that you can have the larger deduction and pay less in taxes. So oftentimes people deduct their property taxes every year and they make charitable contributions every year. But most people still take the standard deduction every year since their itemized deductions just aren't high enough to be able to take the itemized deductions over their standard. According to an article from the Tax Policy Center, back in 2022, only about 10% of people chose to itemize. Yet about 69% of the population gives to charities. And this is according to a nonprofit source, and this was in 2024. This means that even though those dollars are still going to good use, hopefully, they aren't necessarily making any positive impact on your tax return if you're taking the standard deduction. Now here's where this bunching strategy really comes into play. So let's say for this example, you're married filing jointly. Your standard deduction, just for the sake of this example, is $32,000. For many people, having itemized deductions above that amount doesn't really happen in any given year. So in result, they always are taking the standard deduction. But let's say on an annual basis, you are donating $10,000 to your qualified charity or church, and your property deduction every year is about $15,000. This is where this bunching strategy really can help you pay potentially significantly less in taxes over multiple years. So instead of contributing or deducting these amounts every year, you could essentially contribute or deduct double these amounts every other year. So for example, in 2026, you would do 2 years of charitable contributions, $20,000, and you can pay and deduct 2 years worth of property taxes, since oftentimes you can pay property taxes in advance. So this would be $30,000. This would now bring your itemized deduction in 2026, for example, to $50,000. Then in 2027, you don't need to donate to charity because you did 2 years worth last year. And since you paid for 2027's property taxes last year, you don't deduct property taxes either. This means that for 2027, you'd go back to the standard deduction. Basically, this means that each year you would be alternating between taking itemized deductions and then taking the standard deduction. So if you extrapolate this out, let's say over the course of 6 years, you've now deducted $246,000 compared to $192,000. So you've essentially lessened the amount that you're paying in taxes by about $54,000. Now, if you extrapolate that even further over decades, you can see how this strategy can have huge potential tax benefits. The next strategy helps solve for the issue that many high-income earners face, which is getting more money into tax-free investment accounts. For example, specifically, we're talking about Roths here. So Roths are powerful retirement accounts that allow your money to grow tax-free, and they also aren't subject to required minimum distributions. Now, we've already done a few different videos on this topic, so I'm not going to go too deep into the individual points, but if you are interested in learning more about Roth conversions and different types of strategies regarding Roths, feel free to check out some of the videos on our channel. So this strategy is essentially a legal loophole for high income earners who are currently unable to contribute directly to a Roth IRA due to their income being above the annual IRS Roth IRA contribution limits. So this strategy works like this. So if your income is too high that it prohibits you from making a direct contribution to a Roth, all you may be left with when it comes to IRAs is just potentially a traditional IRA. That's an important part of this strategy too, because the way that it works is you would do a non-deductible contribution to a traditional IRA. So because you're not claiming the deduction, you can now convert that IRA contribution to a Roth IRA and pay less or potentially no additional taxes on that transfer. So rather than contributing directly to the Roth, you did it in 2 steps through a loophole in the current tax law. Keep in mind that the IRS does have a pro rata rule for these conversions. It's important to do this carefully and strategically because if it's done incorrectly, there could be some unintended tax consequences. But with that said, this strategy still may be great for some people to help them get assets into Roth accounts and potentially and hopefully have them pay less in taxes over time. So typically when you rent out a property to somebody, that property is considered a rental property or an investment property, and the income generated from that rent is considered income. But what if there was a way to rent out your home, which isn't a rental property, and not have to report the income? This is exactly what the Augusta Rule helps solve. So if you're a golfer, you probably heard Augusta and immediately thought the Augusta National Golf Club, which is the home to the Masters tournament. So this rule was specifically created for people who lived around this famous golf club to rent out their own homes to people that were coming from out of state to come watch this massive tournament. The rule basically allows for people to rent out their primary or secondary residence for up to 14 days annually with no need to report the income that you make from this to the IRS, or you also don't have to classify your home or vacation home as a rental. Basically, it means that the money made during this rental period is like tax-free income. Aside from actually renting out your home to a random person, there is actually a way you can potentially rent out your home to yourself. This strategy must be implemented properly, just like all the other strategies, but this one specifically, because even if you do it properly, it can still potentially raise a red flag for the IRS to do an audit. So you want to make sure that you're doing this correct. But the way that you might be able to do this is if you own a business. If you own a business, you may be able to rent out your home to your business for that 14-day period as long as you meet the IRS requirements, which I highly recommend you read up on or use a financial professional. But your business would essentially be paying you that tax-free income as long as you stay within that 14-day period, as well as your business may get the deduction for the rental space. Now, it's got to be for fair market value and it has to be a legitimate use of business, but this is a strategy that business owners may be able to take advantage of. Next one is for all the real estate investors. So let's say you own an investment property that's gained a lot of value over recent years, and what if you're ready to sell and upgrade that property? Maybe you'd like to get rid of the older property that may have a lot of issues, or you'd rather purchase something newer, maybe something easier to maintain. That all sounds great, except that if you sell your current property, you may owe a large capital gain on that sale, as well as potentially ordinary income on the depreciation recapture, especially if it's in a place like the Jersey Shore, where I've seen prices go up well over 100% in recent years. This strategy, called the 1031 exchange, allows real estate owners to essentially trade their one investment property for another investment property, deferring gains on the sale until a later date or potentially forever. So imagine this. Let's say you bought a property at the Jersey Shore back in 2010 as an investment property. So this is a property that you rented out to people, and let's say that when you purchased that property, you purchased it for $500,000 and now it's completely paid off. Since 2010, maybe that property's gone up to 1.2 million. And now for whatever reason, you want to sell this property and roll the money into a new investment property. Well, if you sell the property, you would realize a $700,000 capital gain and 16 years of depreciation. If you're a high income earner and you're in the 20% long-term capital gain bracket, this could potentially result in taxes being paid of about $140,000 and ordinary income taxes on the depreciation recapture up to that maximum rate of 25%. But instead of selling the property now, paying the taxes, then buying a new property in two separate steps, you could do a 1031 exchange. The 1031 allows you to exchange your current investment property for another like-kind property. And if it's done properly within the time frames required, and they are strict with these time frames, you'd be able to defer taxes on the first property, and then you'd be able to roll the basis into the new investment property. So if you do the 1031 and you exchange your $2 million property into another property, and let's just say that your adjusted basis on the first property is $500,000, the basis of your new property would be $500,000. So you don't always get to get rid of the gains, except in a couple of very unique situations. And there are some strategies with that, so that we could talk about that in a part 2. So if you'd like to see a part 2 in this video, comment down below. But in short, the 1031 could be a massive help in efficiently exiting a specific property and timing when, if ever, you pay the taxes. It can get very complex, and debt must be accounted for, and you could end up owing some taxes if things aren't done properly. So again, I highly recommend that you work with a financial professional to see if this strategy works for you. We've helped clients accomplish this, and it can be very powerful. This last strategy kind of dovetails off of the 1031 strategy that we just talked about, and it's easily the most advanced. So we talked a little bit about capital gains, and with this strategy, you purchase a specific type of investment that's designed to potentially defer capital gains and get tax-free growth. So this investment is called a qualified opportunity zone. This ties directly back in with the beginning of the video where we talked a little bit about things that the government incentivizes. These were introduced back in 2017 as a way to get investments in economically distressed areas. Now real quick, let's go back to our Jersey Shore example. So you sold your investment property for $1.2 million and you're looking at that $700,000 capital gain. In a 1031 exchange, you would have to reinvest the entire $1.2 million into a new property to defer all your taxes. But with a QOZ, you only have to reinvest that $700,000 into a qualified opportunity fund. This gives you a lot more flexibility because now you could take your basis, or more specifically, you could take your adjusted basis off the table and put it in your pocket tax-free. So here's why people love this strategy, because first, it's the deferral. So under the original rules, you can defer the taxes on that $700,000 gain until the end of 2026, which I know is coming up really soon. But under the new rule, any investments made after January 1st, 2027 are deferred on a 5-year rolling period. So if you are considering this type of investment, you might want to consider waiting until after January 1st, 2027 if your goal is to defer those taxes for a long period of time. Second is tax-free growth. So this is the big one. If you hold the QOZ investment for at least 10 years, any appreciation on that new investment becomes 100% tax-free when you sell it. So if that $700,000 investment into the Opportunity Zone Fund grows to $2 million over the next decade, you wouldn't owe a single cent on capital gains tax on that $1.3 million profit. It is important to note that while a 1031 exchange is for swapping real estate, a QOZ is a way to reinvest gains from almost any asset, including stocks, businesses, real estate, into specific communities that the goal is to prop them up. So it's a complex move and it has strict deadlines, and you'll likely again want a financial professional and a tax pro in your corner for this one. And understand that even though the gains may be tax-free, there is no guarantee that it will have gains, and it could very well lose money over those 10 years as well. Also, QOZs are oftentimes illiquid for long periods of time, so that should be taken into account when deciding if this investment is right for you. And also, the risk of the development project does need to be thoroughly evaluated. I know I keep mentioning that you might want to work with a financial professional, and it may seem redundant, But these strategies, even when it comes to just the bunching strategy that we talked about in the beginning, can get complicated and they might not make sense for you. So we've seen in many cases where prospective clients have come to us with major tax issues when even trying to implement the simplest strategies. So we truly believe that you should have a team of professionals that work with your tax professionals as well as all of your other financial professionals to help double check and make sure things are being implemented properly and that they actually work with your overall financial plan. This is exactly what we do for our clients. But if you enjoyed this video, please leave a like and subscribe. Also comment down below if you want to see a part 2 to this video, and I'll see you in the next video.